I'm CA Anil K. Jain, the author of The Development Dilemma. Today we're going to talk about a critical topic from my book, how India's restrictive forex management has, at times, hampered its economic growth. The challenges of restricted forex management. Foreign exchange, or forex, is the lifeblood of international trade. It's the currency a country needs to buy and sell goods and services globally. In India, the Foreign Exchange Management Act, FEMA, and the Reserve Bank of India, RBI, have long governed these transactions. While these regulations are meant to protect the nation's economic interests, they've also created some significant obstacles. One of the biggest issues is limited capital mobility. Before 1991, India had a highly regulated system with strict forex controls. This led to a sluggish economic growth rate of around 3.5% annually. After the 1991 economic reforms, when we started to liberalize, our GDP growth soared to 6 to 7% in the following decades. This shows a clear correlation. Freeing up capital allows for growth. Another major challenge is being a barrier to global integration. Complex and slow approval processes can deter foreign investment. Think about the Walmart-Flipkart deal in 2018. It was a massive $16 billion acquisition that faced significant delays due to regulatory hurdles. Or consider Vodafone's investment, which was plagued by long legal battles over retrospective tax demands, creating an uncertain investment climate. These are not isolated incidents. Similar issues have been seen in countries like China, Argentina, and Nigeria, with their own restrictive policies. This brings us to a crucial point: dampening investor sentiment. A complex and opaque regulatory framework, like India's license Raj before the 1990s, makes investors wary. It increases operational costs and uncertainty, causing potential investors to look elsewhere. Restrictive forex policies can lead to several negative outcomes. One is inefficient capital allocation. When the government tightly controls foreign exchange, investments might be directed to less productive sectors based on policy preferences rather than market needs. For example, Argentina's tight controls have often led to prioritizing consumer goods imports over essential capital goods, stifling industrial growth. This can also lead to informal or black markets, where currency is traded at a premium, creating economic distortions. Zimbabwe's hyperinflation is a stark example of what can happen when black markets thrive due to stringent controls. Furthermore, these policies can cause currency volatility. When governments disrupt the natural supply and demand of currency, it can lead to a significant gap between the official and black market exchange rates. Argentina, Venezuela, and Zimbabwe have all experienced this, leading to economic instability and inflation. While India has a more stable system, it still has to manage the risk of such volatility. India's reforms and their impact. Thankfully, India has been proactive in reforming its forex management. Some key initiatives include Liberalized Remittance Scheme, LRS. Introduced in 2004, this scheme allows residents to remit up to $250,000 annually. This has given Indians more financial freedom, but it also creates pressure on our forex reserves and raises concerns about capital flight. Dual approval route for FDI. This two-pronged approach uses an automatic route for certain sectors, which has attracted global giants like Amazon and Samsung, while a government route maintains scrutiny in strategic sectors like defense and telecom. Increased FDI limits. The government has progressively liberalized FDI caps in various sectors. As you can see from this table, sectors like automobiles and banking have seen their FDI limits increase significantly. However, crucial areas like agriculture, healthcare, and rural development still lag behind, highlighting an uneven distribution of foreign investment. External Commercial Borrowings, ECB. This policy allows Indian entities to take commercial loans from non-resident lenders. While it provides access to cheaper funds for large-scale projects, it exposes companies to significant exchange rate and interest rate risks. The rupee's depreciation in 2013, for example, increased the repayment burden for many companies with substantial ECBs. Foreign exchange reserves. Despite these challenges, India's foreign exchange reserves are robust. As of June 2024, They stand at around $653 billion, which is enough to cover about 10 months of imports. The reserves are a mix of foreign currency assets, gold and other instruments. However, our reliance on the US dollar and low returns on these reserves are areas that need careful management. In conclusion, India's Forex policy faces a classic development dilemma. To unlock our full economic potential, we must strike a balance between regulatory safeguards and liberalized growth pathways. Promoting transparency, digitization, and investor-friendly reforms in coordination with the RBI and the Finance Ministry is the way forward. I'm curious to hear your thoughts. What reforms do you think are most important for India's economic future?